Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Broadcom Inc., ticker symbol AVGO. We're looking at Broadcom today as a subscriber request. Their business is also trading relatively close to their 52-week low, and they are currently paying out a 3.5% dividend yield, so that is quite a bit better than what an S&P 500 ETF would be paying out. We want to be looking at a company's fundamentals to understand if that's potentially sustainable or not. So we'll be doing just that later on. Right now, Broadcom is trading for $469.47 per share. So far this year, their stock price is down 16%. Over the past 5 years, Broadcom has compounded at a rate of 12% annually. Over 10 years, their stock price is compounding at a rate of 30% annually, which is just insane. And going back over 13 years to when the business was publicly listed, Broadcom is compounding at a rate of 28% annually. Their stock price has increased by 26 times in just the last 13 years alone, and their additionally high 3.5% dividend yield would be added to these returns for as long as they've been paying out dividends. So just huge returns for Broadcom over this time. So Broadcom is trading about $50 over their 52-week low, which is down more than $200 from their 52-week high. They are a very large business. They have a $190 billion market cap. For more background about the company, Broadcom, the combined entity of Broadcom and AVGO, boasts a highly diverse product portfolio across an array of end markets. AVGO focused primarily on radio frequency filters and amplifiers used in high-end smartphones, such as the Apple iPhone and Samsung Galaxy devices, in addition to an assortment of solutions for wired infrastructure, enterprise storage, and industrial end markets. Legacy Broadcom targeted networking semiconductors such as switch and physical layer chips, broadband products such as television set-top box processors, and connectivity chips that handle standards such as Wi-Fi and Bluetooth. The company has acquired Brocade, CA Technologies, Symatex enterprise security business, and has a pending deal to acquire VMware to bolster its offerings and software. VMware owners just recently approved the $61 billion Broadcom merger, with over 99% of the company's shares which voted cast in favor of the deal. Broadcom Inc. was incorporated in 2018 and is headquartered in San Jose, California. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Broadcom based off of their business fundamentals. So this analysis will continue to evolve and improve over time. It's still a work in progress, and it also serves as an opportunity to learn in public. So with that said, let's get right into today's analysis. So starting things off with metric number 1, we want their average return on capital over their last 5 years to be above 14%. So there are 2 reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. The second is that the average publicly listed business earns about a 7% return on capital. So by asking for 14% or higher as a benchmark here, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. So Broadcom's return on capital has bounced around somewhat over this time frame. Over their last 12 months, they're actually earning very high returns on capital at nearly 21%. However, averaged out over the last 5 fiscal years, Broadcom is only earning about a 9% average return on capital. So while that is just slightly above where an average business is, that is below that 14% benchmark we're looking for. And so this is going to be an X to start things off on metric number 1. Next up for metric number 2, here we're taking a high-level overview of the cash coming into the business. We're looking for growth in their revenues, earnings, and free cash flows over the last 5 years. And this metric is all or nothing in nature. Either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric will be an X. So over this time, including their last 12 months worth of numbers, Broadcom has grown their revenues by more than 80%. Their earnings are also up, however, they've been rather sporadic throughout this time. 2018's earnings were up big because of a tax income break. But probably the most important aspect of this is that including their last 12 months worth of numbers, their free cash flows are up almost triple over the last 5 years alone. So that is very strong growth. This growth would include the fact that they've had a number of mergers and acquisitions over this time, and with their upcoming VMware acquisition, this likely seems to be the case going forward, but nevertheless, they've strongly grown their business. This is going to be our first check on metric number 2. Next up for metric number 3, here we're building off of the previous metric, but we're looking at the business on a per share basis from the perspective of an individual shareholder in the company. So we're looking for earnings per share growth over the past 5 years. Again, 2018 was an atypical year for the business because of an income tax break. We learned that in metric number 2, their earnings were up over this time. Earnings are only the numerator in this equation. Thankfully, though, their denominator has not changed much. Broadcom has only issued about 3% additional shares over the last 5 years, which is somewhat surprising given their mergers and acquisitions. But it's likely a good thing for shareholders that they were not excessively diluting shareholders throughout this period and that they were still able to grow their business. So this is going to be another check here on metric number 2 as they've managed to grow their earnings per share over the last 5 years. Metric number 3 is going to be very similar. Here we're looking for free cash flow per share growth over the past 5 years as well. Again, their free cash flows are up almost triple over this time, and because they've only diluted shareholders by about 3%, which in and of itself isn't great, but it's acceptable, they've managed to grow their free cash flows per share by quite a bit, almost up at the same rate that their free cash flows are up. So this is another check here on metric number 4, and so far through our first 4 metrics, we are 3 for 4. Next up for metric number 5, here we're looking at the amount of leverage that the business is utilizing. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So for this metric, we want their net debt, which is long and short-term liabilities minus cash and short-term investments, to be below the amount of free cash flow that Broadcom has produced over the past 5 years. So Broadcom ended last year with $28 billion in net debt. They've increased this over the past year to currently they have $29.5 billion in net debt, which does seem like it's a lot. However, over the last 5 years, Broadcom has produced more than $48 billion in free cash flow. So that is a lot of free cash flow that they're bringing in, and that is way more than enough to be able to healthily support their debt load. So this is going to be a check on metric number 5. It is worth noting that with this VMware acquisition, you do want to do the work to understand how Broadcom would be potentially paying for that. So sharing some of the details of that VMware acquisition, VMware shareholders can either elect to receive $142.50 in cash, or about a quarter of a share of Broadcom's common stock for each VMware share that they hold. The deal is subject to proration so that approximately 50% of VMware shares are going to be exchanged for cash, and the other 50% are going to be exchanged for Broadcom common stock. So it looks like that $61 billion is going to be split approximately 50-50, with $32 billion of that coming from debt financing and the other $29 billion coming from shareholder dilution. Needless to say, this debt position will be increasing significantly once that merger goes through, but in the meantime, this is still a check. So far through our first 5 metrics, we have 3 checks and 2 X's. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield above 5%. If this is the case, this will give us another potential reason to be interested in the business, as it'll give us a slight risk premium to the rate of the 10-year treasury yield. We're using their total enterprise value because it's going to take into account both their market cap and their net debt position and give us a more realistic economic picture of the business that's more similar to as if Broadcom were a private company. Currently, Broadcom has about a $220 billion total enterprise value, and we learned that over the past 5 years, they produced $48 billion in free cash flow. This means that in an average year, Broadcom is producing about $9.6 billion of free cash flow. So when we divide their $9.6 billion of average free cash flow by their $220 billion total enterprise value, that is going to give us an average free cash flow to enterprise value yield of approximately 4.4%. So that's right in line with the rate of the 10-year treasury currently, but that is below that risk premium we were looking for at 5% on an average basis. So this means that this is going to be an X on metric number 6. Worth noting, however, is that over their last 12 months, Broadcom has brought in significantly more cash flow than what they've been doing in an average year over this time. Broadcom has produced $15.3 billion of free cash flow in their last 12 months. So to get a current free cash flow to enterprise value yield for the business, when we divide their $15.3 billion of their last 12 months of free cash flows by their $220 billion total enterprise value, that is going to give us a 7% current free cash flow to enterprise value yield for the company. This would be above that minimum risk premium we're potentially looking for, and so it's likely that the economic reality for the business is going to be somewhere between these two. Again, keep in mind that all of this financial data only relates to Broadcom as a business. It's not related to any of the potential future that the business would have combined with VMware. So even though the Broadcom section of the business looks good on a number of these different metrics, you'd still want to do your own due diligence and learn more about both Broadcom and VMware in more depth, and especially learn more about this deal to try to understand if this is truly going to be value additive for existing Broadcom shareholders. Then here we're taking a look at Broadcom's dividend profile. So again, Broadcom currently pays out a 3.5% dividend yield, which is well above that of the yield of an S&P 500 ETF right now. Broadcom has steadily increased their dividends per share in all 5 of the past years, and they've also steadily increased their free cash flows per share in all 5 of these years as well. Over this time, Broadcom has maintained a significantly healthy margin between what they're bringing in free cash flows versus what they're paying out in dividends. And so if this is any indication of what the potential future for the business may look like, it looks like Broadcom will be able to sustainably and healthily support a continually growing dividend for a good while to come into the future. This again is going to be dependent on the business's abilities to produce healthy amounts of free cash flow. And while this is no guarantee, things do look good for Broadcom going forward from a dividend perspective, if that's one of the reasons you're potentially interested in the business. And then finally, here we're using a discounted cash flow model to come to a potential fair value for Broadcom. So starting with an average of their free cash flows over the last 5 years, and then projecting these out over the next 20 years, based off of Broadcom's abilities to historically grow their free cash flow since they became a publicly traded business. So assuming a growth stage over the next 10 years where their free cash flows grow at a rate of 20% annually, which amazingly, that's how fast they've grown their free cash flows since 2007. Then if we assume a terminal stage for the business out over the next 10 years after that, so projecting 20 years into the future in total, where their growth rate declines dramatically and falls all the way to 4% annually, then based off of these historical growth assumptions, which are assumptions that you need to confirm or disconfirm for yourself whether or not these are going to be potentially applicable for Broadcom going forward. So you need to do your own homework here. If we're adding in their tangible book value today, then based off of today's prices, it looks like you could reasonably expect about a 16% rate of return going forward from Broadcom, with about a $512 per share fair value for the business. So again, these are based off these assumptions, which you need to do your own homework on to verify or disconfirm. A discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to what you put into the model. So you have to understand whether or not these are potentially going to be applicable or not going forward for the business. Broadcom's past growth encompasses a lot of mergers and acquisitions, and with their upcoming potential merger of VMware, it looks like that would continue to be the trend for the business. So again, not all of this would be organic growth. In fact, probably most of it hasn't been. Also keep in mind that this discount rate would be including their dividend yield. So 3.5% of this would be distributed to shareholders as dividends. And then most importantly, this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in summary, Broadcom checks the box on 4 out of 6 of our metrics. They're earning just slightly above average returns on capital that were below that 14% benchmark we were looking for. They're only coming in at about 9% on average. Due to some mergers and acquisitions, the business has grown their revenues, earnings, and free cash flows all by strong amounts. Even with all of this deal-making activity, they've only diluted existing shareholders by 3% over the last 5 years, and so their per-share metrics are up as well. However, about $29 billion of their VMware deal is going to be coming from a share swap, so they will be issuing new shares as part of that deal. Then looking at the amount of leverage in the business, currently they're producing a lot of free cash flow to be able to support all of the debt that they have in the business. But again, with their VMware, they're going to be taking on $32 billion in debt and assuming debt from VMware's business. So their ability to service this high absolute debt load is going to depend on how their acquisition goes and how they're going to be able to bring in free cash flows from VMware. Then on an average basis, their free cash flows to their enterprise value yield are just about right in line with the rate of the 10-year treasury yield. And so that does not give us that potentially adequate risk premium we were looking for. But on a current basis, it looks like the business would. So the reality for the business is likely somewhere between the two. Then looking at their dividend profile, it looks like Broadcom is able to healthily and sustainably support a strong and growing dividend with even stronger and growing free cash flows. They've done so over the past 5 years, and it's reasonable to expect that they'd be able to continue doing so into the future. And finally, performing a discounted cash flow analysis of Broadcom, taking an average of their free cash flows over the last 5 years and projecting those out based off of how Broadcom has been able to historically grow their free cash flows since 2007. So based off of those assumptions, which you need to do the work on to validate or invalidate for yourself and to determine whether or not those are going to be potentially applicable to give a baseline projected estimate for Broadcom going forward, then you could reasonably expect about a 16% rate of return going forward from Broadcom from today's valuations. It's worth reiterating that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Broadcom and their upcoming VMware acquisition. So one resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about Broadcom is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community written articles on different stocks, but over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's very own algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years worth of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's just 27 cents per day through my referral link down in the description below. Normally premium is $239, but they are currently running a general offer for $119. But if you use my link, it's even cheaper, just $99. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct your research as if you're going to own 100% of the company going forward, and you can truly understand the underlying essence of that business and understand what's important and what's not important for the company. So through this deeper research, you'll be able to learn more about both the qualitative and the quantitative aspects of Broadcom and be able to determine for yourself what a reasonably appropriate intrinsic value for the business will be. So with that said, that's it for today's fundamental stock analysis of Broadcom Inc., ticker symbol AVGO. Broadcom was a business that was very highly and adamantly requested by subscribers, so I'm happy to make an analysis of it. So if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Broadcom with me, and have a great day.